Mortgage life insurance is offered through your bank when you qualify for a mortgage. The idea is that if you pass away before your mortgage is paid off, mortgage insurance will pay off your balance so your family doesn't have to. Sounds like a no-brainer, right? Wrong. Only because there is an alternative option that your bank won't tell you about, which is a term life insurance. But wait a minute, aren't they the same thing? That's what the bank wants you to believe. You'll be shocked to find out the differences, but first of all, what is term life insurance? It's a life insurance that pays out lump sum cash, tax-free, directly to your family if you die between the term of your contract. Let me repeat that. Lump sum cash, tax-free, paid directly to your survivor. The term usually goes from 10 years, 15 years, 20 years, 25 years, 30 years, and so on. Your monthly payments and your death benefit will remain fixed for the duration of your term. Now, having understood this, I'm going to explain to you why you should never buy mortgage life insurance from the bank. Mortgage insurance is actually a creditor insurance. You're insured against the balance of whatever money you owe to your lender. Because this type of insurance clears off your balance only, your family won't receive any money from it. Compared to a term insurance, where the money is released to your family directly and have full control over how they can use the money, mortgage insurance serves to benefit the lender. You're supposed to pay for what you get, but not when it comes to mortgage life insurance. The payout gets smaller and smaller as you pay off your mortgage, and yet the monthly fee remains the same. Whether you owe $100,000 or $500,000 on your mortgage, the lender will charge you the same rate regardless of your balance. Did you know that when your mortgage renews, your mortgage insurance has to as well? This is because, once again, mortgage insurance is creditor insurance. It follows your lender, not you. If you find a better rate elsewhere and want to switch your mortgage, you now have to buy mortgage insurance with the new lender at a higher rate because you'll be older by then. What's worse, if you've had any major changes to your health, there's a good chance you won't qualify for it anymore. Compare this to a term life insurance. The contract will follow you whether you even have a mortgage or not. It's fully portable regardless of which lender you choose to get a mortgage from. Mortgage insurance uses what's called the blended rate, meaning they charge the same rate regardless of your gender, smoker status, or your health. This is great news if you're a smoker, heavily overweight, have multiple health concerns, etc., etc. But for an average Canadian in their 30s, 40s, and 50s that are in good health, depending on your health history, you may get away with paying about half of what mortgage insurance will cost. This is because term life insurance assesses your risk individually and not as a group, where there's bound to be unhealthy people in the pool. Last but the most important, your family may be denied the claim upon death with mortgage insurance. Now, how is this possible? You may have heard such horror stories. After all, it's quite common occurrence and was aired on national TV, among others. Just type in mortgage insurance claim on Google search and see what is on top of the search list. Mortgage insurance claim denied. This is no coincidence and is one of the major reasons why you should avoid mortgage life insurance at all costs. The underwriting process with mortgage insurance is very different from term life insurance. Banks use what's called post-underwriting, meaning they'll review your health records and questionnaires after death, if that even makes any sense to you at all. If they have any reason to believe you weren't being truthful when you bought mortgage insurance, they can refuse your claim. Whereas with term insurance, everything is asked and checked up front, which leaves no room for any misunderstandings. To sum it all up, term life insurance is just the opposite of everything wrong about mortgage insurance. Your family will get money, lump sum, tax-free instead of the bank. As to how they use it, it's completely up to them. Your family will get the original coverage amount regardless of your mortgage balance. Your term life insurance is fully portable regardless of which lender you deal with. Your monthly rate is fixed for the term, so you don't have to worry about the renewals. Also, your monthly rate will likely be cheaper because it's based on individual rate and not a blended rate. And finally, no one will challenge the claim upon death. This guarantees your family will be left with the money. If you're under the age of 50 and you're looking to get term life insurance, the process should be extremely smooth and simple. Applications can be filed over the phone or online without the need of meeting anyone face-to-face, and everything is done electronically, which minimizes any paperwork. If you're over the age of 50 or if you have some health concerns or medical history, chances are very good that a nurse visit will be required where they'll come out and see you to do various testing such as blood work, urine sample collections, ECG testing in some rare cases, and they'll check your vitals, and they may ask additional questionnaires to properly assess your risk.